Picture this. You wake up, grab your phone, and check your investment app. Your stomach drops. Your portfolio, the one you've carefully built over years, has plummeted 30% overnight. The news headlines are screaming recession. Your social media feed is flooded with panic. And that retirement date you've been planning for? It suddenly feels much further away. Now imagine a different scenario. Same economic crisis, same market meltdown. But you're calmly sipping your coffee, checking your investments, and seeing your wealth not just protected, but positioned to grow while everyone else is in full panic mode. The difference? Preparation. I've been through 3 major market downturns in my investing career, and I've learned that recessions don't destroy wealth. They simply transfer it from the unprepared to the prepared. During the 2008 financial crisis, while most investors were losing sleep and selling at the bottom, I was strategically building positions that would later multiply several times over. Today, the warning signs are flashing red again. Debt is climbing at an alarming rate. Unemployment is poised to tick higher, and GDP growth is beginning to sputter. The market's recent strength? An illusion created by just 7 companies, the so-called Magnificent Seven, masking the weakness underneath. But here's the good news. You don't need to be a Wall Street insider to protect your wealth in what's coming. In the next few minutes, I'm going to reveal the 3 financial fortress strategies that have historically shielded investors through every recession while setting them up for explosive growth on the other side. These aren't theoretical concepts or untested ideas. These are battle-proven sectors and specific investments that have consistently outperformed during economic contractions for decades. And right now, before the recession officially begins, is your window of opportunity to position yourself on the right side of the coming wealth transfer. If you're serious about protecting your portfolio from what's coming, smash that like button and subscribe now for more wealth protection strategies that most financial advisors won't tell you about. The perfect storm brewing. Let's cut through the noise and see what's really happening. Our economy is sitting on a debt time bomb that's ticking faster by the day. Unemployment isn't just a number. It's the first domino in a long row that's starting to wobble. And our economic engine? The check engine light is flashing with GDP growth slowing to a crawl. Here's the most dangerous part. Over 50% of recent market gains came from just 7 companies, the Magnificent Seven. That's not market strength. That's a house of cards. But I'm not here to scare you. I'm here to prepare you. Because while recessions transfer wealth, they transfer it from the unprepared to the prepared. The good news? History has revealed 3 fortress sectors that not only survive downturns, but often emerge stronger. These aren't complex strategies. They're essential businesses that keep generating revenue no matter what's happening in the economy. Let's dive into these 3 recession-proof sectors that could be your financial shelter in the coming storm. Sector 1. Consumer staples. When recession hits, the first things people cut are luxuries. That Caribbean vacation? Postponed. The designer handbag? Not this year. The latest tech gadget? It can wait. But what never gets cut from the budget? The essentials. Toothpaste, soap, food, beverages, cleaning supplies. These aren't optional purchases. They're non-negotiable necessities. This is why consumer staples companies don't just survive recessions. They often thrive during them. While luxury brands watch their sales plummet, companies selling everyday essentials keep their cash registers ringing. Look at what happened during the 2008 financial crisis. While the S&P 500 crashed by over 50%, the consumer staples sector outperformed by nearly 15%. During the COVID crash? Same story. When fear takes over, investors flock to safety. The easiest way to add this defensive strength to your portfolio is through the Consumer Staples Select Sector SPDR ETF, ticker symbol XLP. With $15.7 billion in assets and a rock-bottom expense ratio of just 0.08%, it gives you instant exposure to the entire sector. This ETF holds 41 recession-resistant companies, including household names like Costco, Walmart, Procter & Gamble, and Coca-Cola. Over the past 12 months, while growth stocks were getting hammered, XLP was up 9%. And that's before we're even in a recession. But if you prefer to pick individual stocks, take a close look at PepsiCo, what I call recession-resistant royalty. When times get tough, people don't stop treating themselves completely. They just find smaller, more affordable luxuries, like a Pepsi or a bag of Lay's chips. It's the lipstick effect of consumer behavior. Right now, PepsiCo shares are down 19% over the past 12 months, giving us a rare discount on this defensive powerhouse. With a dividend yield of 3.8% and 52 consecutive years of dividend growth, it's practically recession-proof income. Even better, it's currently trading at a forward PE of just 17.3 times, well below its 5-year average of 22.6. In terms of EV to EBITDA, shares are at their cheapest level in over a decade. This isn't just a defensive play. It's buying a premium company at a discount before everyone else realizes they need it in their portfolio. Remember, in a recession, it's not about finding what will grow the fastest. It's about finding what won't sink with the ship, and consumer staples is your financial life raft. Sector 2. Healthcare. If there's one thing people won't compromise on, even when money is tight, it's their health. Economic recession or not, medications still need to be taken, treatments can't be postponed, and healthcare remains an absolute priority. This is why healthcare stocks have historically been one of the most resilient sectors during economic downturns. While discretionary spending plummets, healthcare spending barely budges. Think about it. During the 2008 financial crisis, while banks were collapsing and retailers were filing for bankruptcy, healthcare companies continued generating steady cash flows. During the COVID crash, while travel and entertainment stocks were in free fall, many healthcare stocks were busy reaching new highs. The simplest way to add this recession shield to your portfolio is through the Healthcare Select Sector SPDR ETF, ticker XLV. With a massive $35 billion in assets and a minimal expense ratio of 0.08%, it's the most liquid and cost-effective way to gain exposure to the entire healthcare industry. This powerhouse ETF holds 61 leading healthcare companies, including giants like Eli Lilly, Johnson & Johnson, Abbott Labs, and Merck. And despite United Health Group's recent 20% single-day drop weighing on performance, the current pullback represents an exceptional entry point rather than a reason for concern. For investors who prefer individual stocks, AbbVie, ABBV, stands out as what I call the investor's trifecta, offering share price appreciation potential, solid dividend yield, and strong dividend growth. While the stock is down about 3% year-to-date, this creates an attractive entry point for one of healthcare's most reliable players. With a dividend yield of 3.8% and 11 consecutive years of dividend growth, AbbVie provides that steady income stream that becomes so precious during market turbulence. What makes AbbVie especially interesting is its current valuation. Trading at a forward PE of 14.2 times, the company is transforming its perception in the market, similar to what happened with Merck and Amgen before their multiples expanded. This is a stock that should be trading closer to 15 times earnings, suggesting upside potential even in a defensive play. The beauty of healthcare stocks is that diseases and medical needs don't disappear during recessions. If anything, economic stress can increase certain health issues. This creates a business model that's inherently insulated from economic cycles, exactly what you want when storm clouds gather. Remember, when recession fears rise, think about investing in the sectors that people simply cannot cut from their budgets, and healthcare sits at the very top of that list. Sector 3. Utilities. When economic storms rage, utilities become your portfolio's lightning rod, grounding you while chaos strikes all around. Think about it. What's the absolute last bill you'd stop paying during tough times? Your electricity and water. You might cancel Netflix, postpone that new car purchase, or skip dining out, but keeping the lights on and water running? Non-negotiable. This fundamental necessity is why utility stocks have historically been one of the safest harbors during economic downturns. When markets panic, smart money flows toward these steady income generators, with their predictable cash flows and regulated returns. During the 2008 financial crisis, while banks collapsed and the S&P plunged, many utility stocks weathered the storm with significantly less volatility. Why? Because regardless of whether the economy is booming or busting, people need electricity, water, and gas. The easiest way to add this defensive power to your portfolio is through the Utility Select Sector SPDR ETF, ticker XLU, with $17 billion in assets and a minimal expense ratio of just 0.08%. It's an efficient way to gain exposure to the entire utility sector at once. This ETF holds 34 utility companies, including giants like NextEra Energy, Southern Company, and Duke Energy. Over the past 12 months, this ETF is up an impressive 17%, significantly outperforming the broader market during a period of economic uncertainty. For investors looking at individual stocks, NextEra Energy, NEE, stands out as what I call the future-proof utility. While traditional utilities offer stability, NextEra adds the growth kicker of being America's leading renewable energy company. Here's what makes this opportunity special. While others freeze in fear during market turmoil, NextEra continues building tomorrow's energy infrastructure at recession discount prices. Their focus on solar and nuclear positions them perfectly for the inevitable energy transition. Currently yielding 3.4% with 29 consecutive years of dividend growth, making it a dividend aristocrat, NextEra provides that sleep well at night income stream essential during economic uncertainty. Even more attractive? It's trading at a forward PE of just 18.1 times, well below its 5-year average of 24.4 times. What makes utilities particularly powerful in a recession protection strategy is their counter-cyclical relationship with interest rates. When economic conditions deteriorate, central banks typically lower rates, creating a tailwind for utility valuations precisely when you need them most. Remember, a well-constructed portfolio needs storm shelters, assets that remain standing when everything else gets blown away. Utilities have proven themselves to be exactly that kind of financial fortress across virtually every recession in modern history. The Recession Action Blueprint. Your next steps. Now that you've seen the 3 fortress sectors that can shield your wealth during economic downturns, let's talk about exactly how to implement this strategy. This isn't just about knowing what to buy. It's about knowing when and how much. Here's your recession-proofing action plan. First, assess your recession readiness score. Look at your current portfolio. What percentage is in growth stocks versus defensive sectors? If you're over 70% in growth and cyclical sectors, you're essentially driving without a seatbelt in increasingly dangerous conditions. Consider shifting 20 to 30% of your portfolio into the 3 defensive sectors we've discussed. For conservative investors nearing retirement, aim for a 50-30-20 split. 50% in these defensive sectors, 30% in high-quality bonds, and 20% in cash equivalents for buying opportunities when prices drop further. For younger investors with longer time horizons, a 30-70 mix might be more appropriate. 30% in defensive sectors as a foundation, with 70% still positioned for long-term growth, but focused on high-quality companies with strong balance sheets. Remember, this isn't about timing the exact bottom or selling everything in panic. It's about strategic repositioning before everyone else realizes they need these defensive holdings. The wealth transfer that happens during recessions isn't random. It follows a predictable pattern from the unprepared to the prepared. Which side do you want to be on when this economic cycle completes its inevitable turn? Think about it this way. While others are paralyzed by fear, watching their portfolios crumble, you could be calmly collecting dividends from PepsiCo, AbbVie, and NextEra Energy, and potentially positioning yourself to buy outstanding companies at fire sale prices using the cash you've wisely set aside. This is how generational wealth is built, not by chasing the latest trends, but by understanding economic cycles and positioning yourself accordingly. If you found value in these strategies, hit that like button and subscribe for more recession-proofing insights in the coming weeks. We'll be doing deep dives into each of these sectors and exploring specific buying opportunities as they emerge. In the comments below, tell me which of these 3 sectors you're most interested in adding to your portfolio: consumer staples, healthcare, or utilities. I read every comment and use your feedback to shape future videos. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.